Good morning. Welcome to Stock Market Today. It's Thursday, November 5th, 2020. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider upon further analysis that hits your inbox every trading day before the market opens. So U.S. equities finished higher on Wednesday with growth outperforming value as blue wave bets have started to unwind. Comm services and healthcare led the market. Materials, industrials, and financials declined. Treasuries rallied with a big curve flattening move. The 10-year yields were down about 10 basis points to 77 basis points on the day. Dollar was little changed against the euro and yen. Gold finished down 70 basis points. WTI crude was actually up 4%, so kudos to crude. As we get to the desk this morning, S&P futures are up 1.8%, extending the rally. It's a big three-day rally underway, and today could mark number 4, but we have a long way to go before we hit the 4 o'clock close. We are up over 5.5% on the week. Asian markets saw big gains overnight with Hong Kong and South Korea leading, and I've been really focused on Asia of late, and we need to dig in on that. We're going to look at some charts a little later on in the show. European markets also trading higher. Treasuries are extending their rally with more curve flattening. The dollar is weaker on the major crosses, in particular the euro. Gold is up 1.2%, and WTI crude is down 20 basis points to kick us off on a day 2 of the unwind of the consensus blue wave bets. Everybody piled into the blue wave trade, short treasuries, long cyclicals. It's never a good idea to pile into trades. I think it's always a good idea to gradually shift your positions, right? That's something we've been talking a lot about with our clients. I've talked about it here as well, right? Go back to June when we started to get bullish on materials. Then we were looking at industrials. More recently, I started to look at financials because they were on the verge of outperforming. All three of those got whacked yesterday, especially on a relative basis, right? Which is why you don't go all in, all out on any theme, idea, right? It has to be a gradual shift. The market will take you there gradually. You know, in a lot of the work I was doing, you know, depending on your time frame, the growth theme was still there, owning growth. It was no longer the lay up easy trade that it had been for 2 years, but it was still there. So the people who went all in on the blue wave bet yesterday, they kind of got a key lesson in not putting all your eggs in one basket. Everybody piled into that trade. The trade was, right, like I said, short treasuries, right? Long small caps, long cyclicals, right? And these things were improving. It made sense to be paying attention to them. My concern and my issue is, you know, the all in, all out, and that's what happened. So what do we have here? SPY 320 is still key support. The move through 340 increases the odds of the September highs being hit. For the Qs, you can just move the numbers around. The thesis is the same. 260 remains key support. The move through 280 increases the odds of the September highs being hit. IWM has more of a buffer zone below 140 to 150. We're above that. We increased the odds of the highs from earlier this year being reached, right? So I think if you're an equity investor, you're now playing for the highs while continuing to manage risk. What are your risks right now? Well, your risks are, we still don't know who the president is, right? So there's still scope for this to be a contested election, right? We're starting to see some lawsuits. If we kind of get a clarification within a week or so of who the winner is, market's probably going to keep working, because honestly, I think this is arguably the most bullish setup, right? Split Congress, you know, gridlock in DC. So that's encouraging. But, you know, if we start to get much past a week and this is still being challenged, your risk management process probably has to kick in. So that's just kind of how I'm framing things up as we progress here. Let's hit our market in a minute. What are we writing about in the note today? Well, Qs add more than 4% on the day. SPY closes above 340 to set up the September highs. That's it. That's how I see it. Odds with the move through 340, the odds of the September highs getting hit increased. That's not guaranteed, right? If we don't get there, don't come looking for me. It's just an odds game. Emerging markets rallied to new 52-week highs. Breadth metrics improve on the week, adding bullish support to the story. And futures point to a higher open here today. Now, as we look at the power bars and the major indices, everything improved but the Dow. Dow still 1 to 4, so I guess it improved. There's less bearish stocks after adding 1.4% yesterday. S&P 500 up 2.25, 133 to 91 bulls to bears there. NASDAQ standout up 4.5%, 23 to 13 bulls to bears there. Small caps, massive underperformance, right? This was part of your blue wave trade. So, right, another part of the blue wave trade was to be short tech. And if there was a democratic sweep across the branches of government, we know the tech stocks were going to come under pressure, right? Regulatory risk was going to be real. And in the fact that massive stimulus under a blue wave would probably spark some level of economic growth, right? So the growth theme comes off in a blue wave. But now we're reversing all that. Healthcare, big outperformer as well, as you can imagine. I think a lot of this had to just do with positioning yesterday. What we're seeing this morning probably has to do with positioning as well. And if we assume that we find out who the winner is within a week or so, positions will start to square up and we'll get a better sense of the new trends that are developing. But for right now, they're starting to develop, so we have to pay attention to them. We're always mindful of risk management, but I think what we're seeing now is an unwind of the blue wave bets. Let's hit our stocks of the day. Part of the unwind of the blue wave bets is investors are going to have to buy some growth stocks, I think. They were shorts. They were the layup short or one of the layup shorts under the blue wave scenario, given the regulatory risk, given the fact that increased stimulus. I mean, Nancy Pelosi was at 2.2 trillion in her negotiations for stimulus. If there was a blue wave, she was going to be at 3 trillion probably, right? Like that number was going to be something massively bigger than 2.2 trillion. You have to assume that was going to spark some level of growth, right? So if growth starts to pick up, never mind the fact that we're just going to start lapping easy comps once we get into the first half of next year. So if growth is starting to pick up, right, that the impetus to own growth stocks is not as great as it was as growth was slowing for 2 years. That's why I say the growth trade was easy for 2 years, and all of a sudden it became less easy. But now with the blue wave not playing out, perhaps we have a situation where we don't get as big of a stimulus package as everybody hoped. You also have COVID spiking again. So maybe growth starts to slow down a bit again. All of a sudden, growth stocks look interesting. Right? It's ever changing. This is why you can't be all in, all out on a single bet, or it's not advised. You could do whatever you want. So let's start looking at growth stocks. Using that as a starting universe. Let's find the ones that are bullish and very bullish. Let's find the ones that are oversold with strong money flow and strong relative strength, i.e. they're set up now, I think. Take a screenshot of this. If you're doing work and looking for ideas, I think you have 29 names to start with right here, right now. That's how I'd come at it. As a matter of fact, that's how I will come at it. As soon as I wrap up this show, that's exactly what I'll spend time doing. Looking at some of these stocks and figuring out if any of them look compelling and are a fit for my portfolio at the moment. Take a screenshot, take a look if that's what interests you. Otherwise, move along. The next screen will be for you. But this is how I'm framing things up today. Let's look at our sector tracker now. Movement over the last 5 days. We went from everything red to a few greens to everything green. Healthcare, energy, comms, top of the list, along with industrials and now tech bumping into the top 5. We like to see that. Materials, REITs, fins, middle of the road, discretionary staples, Utes, bottom of the list. And ideally, with the market now back above 340, I'd love to see these Utes start lagging, right? One of the big concerns, or not big concerns, but something I had in the back of my mind was utility outperformance. Now I want to see them start to lag, okay? So that's what I'm watching for. Industry in focus, home builder services, past 6 months, been a monster outperformer. We know it, we love it. I get constant questions on the builders, and for good reason. It's been a great call. We've been bullish on it, and it's been the right call. Up 35% relative to the SPYs over the last 6 months. Power bar ratio, very strong. 22 bulls, 0 bears, currently ranked number 1. You want to look at names like MHO, Century Communities, and TriPoint as very bullish ideas, right? Do the work, right? You don't just go out and buy these stocks, do the work. They are holdings in names in an ETF that really just kind of looks like a nice consolidation within the context of an uptrend. XHB is very bullish. The trend is strong. We're above that rising long-term trend line. We are oversold with the indicator rounding higher, and we're seeing the intensity of outperformance begin to pick up again. The only knock I have here is money flow, which has come off with this pullback, which you kind of expect to see it come off as it pulls back, but we've held support. I think as long as you're above 50 here in the near term, you got to be bullish builders and their supply chain. Remember, XHB is not pure builders, right? Always drill down on holdings of ETFs. XHB is the home builder ETF, right? But, it owns the supply chain too. You'll find names like Whirlpool, Home Depot, and Lowe's in there. And that's fine. Those are quality names that have been working. So drill down. Don't be lazy. Do the work. Drill down. You never know what you're going to find. You might find 3 or 4 other opportunities that you didn't know existed by just doing a little bit of extra legwork. I encourage you to do that. Let's look at our trending names now. Yesterday's movers and shakers. Some positive developments for Biogen's Alzheimer's drug. Send the stock higher 44% on the day. What more can you say there? Nice. Good for you, Biogen bulls. Managed care caught a bid yesterday. Again, an unwind of the blue wave trade. Blue wave trade would have been bad for managed care, so we unwind that. Cigna, Anthem, United Healthcare all go up 14%, 11%, and 10% respectively. And Eli Lilly provided an update on their manufacturing remediation. That stock higher by 14%. Healthcare was just on fire yesterday. Part of it, blue wave, some company-specific ideas. Loser side of the board, right, is the same theme, right? URI and VMC. These are names that are levered to a massive fiscal stimulus and spending bill, right? URI rents out heavy equipment. Vulcan Materials, right, material company. There's literally not a road that gets paved that probably doesn't have Vulcan Materials products in it, right? So to the extent that massive infrastructure spending is off the table, or not even off the table, if you thought it was going to be X and now it's some number less than X, these names have to come in, and that's what's happened. Other side of that is we saw what happened, right? The other side of the trade was massive short treasuries. So they've ripped higher, yields went lower. That hurts the banks, CMA, MTB, and Zion. So let's dive into the show, to the charts. Breath is bullish again. And maintaining. Remember, 60% is a healthy majority for the percent of stocks above their 200-day. We're there. We're getting there on percentage of stocks above their 50-day, and we are back above the September peak for the AD line. So breath confirming that odds of the September highs being reached are increasing. So I think that's a positive development if you're bullish. We've liked emerging markets for a long time. I write a weekly strategy piece called the Market Survival Guide that gets published on Tuesdays. And we recently turned bullish on emerging markets. And we got a breakout here. EEM, like what they saw here in the US, the fund breaks higher, the emerging market ETF. This is largely a bet on Asia. It's 60% Asia. I think there's a huge China component here. So I think that's interesting. And if you think about why that makes sense in terms of the election, the logic will come to you. On a relative basis, we're starting to round higher as well. And I think a big part of that is China. Take a look at the A shares, ASHR breaking to new highs here. Nice consolidation and then a breakout. On a relative basis, not at a new high yet. If we wanted to kind of get tricky and draw the triangle, I guess we could. That's not really my game. I'm looking for the trend, so I'd like to see a breakout here to confirm, but China's obviously doing well. That's going to wrap us for today. Take us for a test drive. I'm back with you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.